Insolvency trading has been extended. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, because we're going to need it for this one. I'd like to have a look at an article from the Financial Review discussing the extension of insolvency trading until next year. Now, before we get into that, I just want to draw your attention to this website, the ASIC published notices. You can just type in ASIC insolvency notices, and you will be able to see, sadly, all of the businesses that have been put in liquidation, insolvency, or are getting wound up one way or another. All of the notices, and every day. It's, well, even though the number of insolvencies is about 60% less than it should be, it still is a bit depressing having a look at all of these businesses winding up, disappearing, getting destroyed. Now, I've been harping on about my concerns with regards to trading while insolvent for some time. The reason is because as a director of a company, if you were trading while insolvent, so say, I've got my company, my wife and I have a business, and if we knowingly take on or do business and take on credit from other parties while we are insolvent, because we need to sign a declaration every year saying we're not insolvent, we can fulfill our obligations as they arise, we could be held personally liable, personally responsible. Now, that adds an extra level of protection to people in business when you're dealing with companies. Often they prefer to deal with companies because of all of the provisions in the Company Act. As an architect, we were constantly, back at uni, it was rammed home to us to be wary of insolvency risks for builders. We'd often be the one sitting between the client and the builder administering the contract, and you'd have to approve the payments to the builder from the client. What you didn't want to happen is you didn't want your client to spend more money than what has actually been built, what has been completed. You want to pay them progressively, drip feed the money to the builder so they have enough money to get paid for the work they do, because you don't want the builder taking your money and then buying physical things and putting it on someone else's site, because that's almost impossible to get back, and that's a big element of risk. And also being involved in the construction industry myself, starting up my own business, realizing how the payment terms are so flexible in the construction game. Even though paid when paid is illegal, it still seems to be quite common. And you don't want to make a ruckus, you don't want to make a noise, because you lose clients. And often all of us are in this situation. It's quite frustrating. But it becomes a point where you have to, well, I've learned in business, you need to have enough of a cash reserve to be able to tell people to just kindly get stuffed if they can't pay you on time. It's part of just growing and learning in business. So, I'm concerned about this. I'm worried. This is the one thing that really dissuaded me from taking advantage of Home Builder. I mean, don't get me wrong. I would have happily grabbed the $25,000 of free money the government's handing out to help us do our renovations here at our house. But I don't want to risk having a house up in the air. We've got a Queenslander, guys. We need to lift it and build under. I don't want to risk having a house up in the air with a builder going insolvent. Would you? So the fact that this has been extended is not surprising. They're throwing everything they can to keep the economy going, but it's a little concerning. Literally, this is an example of the good old kick in the can down the road. They are literally kicking the insolvency can down the road. They're letting businesses trade, which in any other time wouldn't have been able to, or would be liable for trading like this. They're letting them go on. This is the problem. The government, we're not in a free market economy, everyone. Don't think we are. We're in a regulated economy. And, well, this is just the political will. People hear a horrible story in the news and then they advocate for their political leaders to intervene in the market, to regulate the market, to manage it. They want the freedom of the market, bookended. Like going bowling with bumper bars. That's how a lot of people want it. And the problem is, in some ways that can be a bit of theatre with regards to how secure you actually are. But, well, it can set up a situation like this where now they can just change the rules. The theatre that they have, the rules that we all need to apply by, have been removed. Let me know in the comments before I go through this, and I'll have a shot of coffee. Let us know in the comments when you've had to chase down someone for, payment? Have you ever gone someone for trading while insolvent? Let us know, because there's some people that have never experienced this, and there are a lot of people in the construction game that I know have got lots of stories to share. You're probably all as bitter and twisted as I am. So that's why I'm glad this is getting some media exposure. So let's have a look at this article as written by Matthew. The Morrison government has extended insolvency trading relief out to 2021 in a bid to prevent further job losses and avoid another massive hit to the economy. So, how many of these jobs or these businesses are being propped up by JobKeeper? The businesses are actually trading while insolvent, and maybe, they've pulled their workers aside and said, "Okay, we're in trouble here. We're going to keep you going as long as we can to get you the JobKeeper, but then we're shutting down." How many of you think? How many people are in that situation? How many of you think that's happening? I wouldn't be surprised. As foreshadowed by the Australian Financial Review in July, the move will see the increased thresholds at which creditors can issue a demand on a company or initiate bankruptcy proceedings extended until December 31st. So, well, there you go. Relief for directors from personal liability when a company is trading while insolvent will also be maintained until that date. And that is the issue there, right there. That is the big issue that concerns me. That concerns me with this. The government said it took the decision to extend the temporary rules, which were due to expire on September 30, to give viable businesses an opportunity to recover from the health crisis instead of failing. Now, here's the thing. They're saying to give viable businesses the opportunity to recover. Now, will they? I'm going to bring up trading economics here, and I really should incorporate this into my slide deck. I just haven't done it yet. Or my slide deck, my stream deck. We look here at GDP growth rates. There you go, 7% fall. Let's go out to the max size of the data. Okay, remember around here in the 90s? That was a recession. See that? That was the recession Australia had to have. This is nothing like we've had in memory. Nothing at all. How many of these businesses do you think are even going to be able to climb back from this? Do you think consumer confidence is going to recover? Or do you think people even realize what this means? Do you think the average punter appreciates the fact that this trading while insolvent is putting a lot of businesses and a lot of people at risk? How many of these businesses are zombie businesses that are just pretty much a hollowed shell of themselves, running on the fumes of JobKeeper to keep going, and should actually go under? I mean, it's through no fault of their own. But, I mean, come on, everyone. This is not normal. This is not normal. This is a chart you see in crypto, not in the GDP of a country. Okay, seriously. The extension of the temporary changes to the insolvency and bankruptcy laws will continue to provide businesses with a regulatory shield to help them get to the other side of this crisis, Frydenberg said. The extended relief will also help to maintain confidence, allowing viable businesses to survive as they adapt to the new COVID-safe economy. Banks are already preparing to deal with company failures. ANZ Chief Executive Shane Elliott said on Friday that the bank was building up teams to deal with the pain next year. So this is it. We are not actually seeing the impact of the economy. This has just manifested. We've got JobKeeper in place. We've got Job Seeker bonus in place. We've got mortgage holidays extended until March. Now we have trading while insolvent extended until December. And the banks are, well, they're talking about a 15% property hit. We're already starting to see that manifest in Sydney, where investors are getting out of apartment stock and some of them are giving 15% discounts. So I suspect we won't see the impact of all of this until next year. Then the question is, will they kick it down the can even further? How long until people lose confidence with businesses, companies in this situation? Would you be dealing with them? We do believe there will be a pickup in insolvencies next year, and we are making sure we're resourced appropriately to deal with that, Mr. Elliott told a parliamentary committee. We're making sure we're preparing for from a resources point of view, so adding people, and a cultural point of view, so how to deal with company failures. Voluntary administrations across the country have fallen 60% compared to the same time last year due to the temporary insolvency protections, according to data from Credit Watch and Siva Consulting Insolvencies Analytics. The Australian Institute of Company Directors survey showed that about 16% of small and medium businesses said temporary relaxations of insolvency trading laws had influenced their decision to continue trading through this crisis. So, is that a good thing? Is that a good thing? If the business was at the edge, if it was at the edge, and you're thinking, okay, probably time to wind up. We'll sell out. We'll be okay. We'll still keep the house, and we'll find other ways to make money. Or if the government changes the regulatory framework so you can trade while insolvent, so people probably push on further than they should have, thinking that everything's going to bounce back, thinking that this is a V-shaped recovery right here. And in February, it all hits the fan, and then people start losing their homes. I can see a much worse story here. However, insolvency industry experts have been calling for the government to adjust the temporary relief to make sure some pain was felt by indebted companies and not just creditors. They want the market, they want businesses. Well, here's the thing. I've had to chase people for money. I've had to chase people, and I still haven't got it. I won a case, a QCAT, everything, and he just did the dodgy. And it got to the point where a contract is only worth so much that you're willing to spend at it. You want to throw good money after bad. You have to realize sometimes you just have to say, oh, well, that's part of doing business. You cop it sometimes. But how many creditors are going to start feeling the pinch? How many tradies are going to start hitting it if builders start going under? They want to see some adjustments to the process that would allow small businesses who wanted to continue trading, rather than go directly into voluntary administration or liquidation, enter an arrangement with creditors that enable repayment of debt on a pro rata basis. Such a scheme would have been similar to the UK's creditors voluntary administration model, but different from the US's Chapter 11. Why don't we have something like that here in Australia? Maybe someone who's in the industry can tell me. Why don't we have something like that in Australia? Attorney General Christian Porter hinted the government was considering such a scheme. As the economy starts to... You know why? It's probably because we've just had it so good for so long. I mean, we've been flipping houses, digging ditches, and serving coffees for 30 years. Now times are getting tough. That's probably why. You know, no barista's gone broke. You just buy more houses. What are you worried about? Just buy more houses. As the economy starts to recover, it will be critical that distressed businesses have the necessary flexibility to restructure or to wind down their operations in an orderly manner. Ashurst partner Michael Sloan said such a scheme would have been a good first step in preparing for inevitable company failures. He also said changing the threshold for which creditors can make claims would have been a wise first step, so the thresholds have been adjusted. He suggested changing the threshold to debt of $10,000 and the time taken to respond to creditor demands to 2 months, down from the temporary relief of $20,000 and 6 months. I mean, see, that's insane. Someone can owe you 20. Like, I had a guy. We did a restaurant design. He screwed us over. $15,000 he owed us. You know, now I couldn't even make a claim. And even if it was $20,000, I'd have to wait 6 months for a response. Come on. Insane. Utterly insane. It just shows you how desperate they're getting. And most people would never have been exposed to this. The average partner has got no idea. They've got no idea. This scares me more than anything else. Probably because I can relate to it. 6 months, guys. What's the longest you've taken to get paid? Let us know in the comments. What is if I think back, I was working on my database. I built the database here to manage my business. And I was looking back at it because I want to try and get off the cloud for my financial and invoicing and build it into my database. So I'm looking back at what I'd done in the past. And I found all these methods I do to chase invoices. How people are paying late. What's the longest it's taking to get paid? Have you ever been successful in charging interest? But 6 months. McGrath, Nicole partner Keith Crawford, said the government needed to realise some Hard decisions should be taken, and some insolvencies can actually help businesses' continuity. The key message is that insolvency is not necessarily the end game, he said. The voluntary administration process is no less important to sustainable business rehabilitation than solvent restructuring techniques. There are certainly a lot of businesses that have come out of VA in much better shape and with much better long-term prospects. Data from the Australian Securities and Investment Commission shows that over the past 20 years, about a third of all voluntary administrations have resulted in deeds of company arrangement. McGrath Nicole, M&A partner Chris Davey, said the comparable data for McGrath Nicole over the past 2 years is about two-thirds. Restructuring initiatives facilitated by the insolvency process, coupled with a newly cleansed capital structure, can deliver a rehabilitated business, generating an immediate profit improvement or alleviating working capital funding requirements, he said. So there we have it. Well, they've kicked this can down the road until the 31st of December. I can't say I'm surprised. I can't imagine Matthew or anyone at the Australian Financial Review is surprised. Let me know in the comments if you're surprised. Is this affecting the businesses that you decide to do business with at the moment? Are you as worried as I am? Let me know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy a merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day. I'll see you next time.